What's up? Good morning. Good morning. What's going on, everybody? Welcome aboard. It is, I guess, the Bubba Show, we'll call it. And lots of news out this week, lots of stuff. And markets are kind of frozen in time. They look like they want to break. Oracle had horrible earnings, you can see here, and they had what we call the blow off, which was actually a potential buying opportunity. But overall, I mean, look at the S&P, which is obviously probably the main benchmark that everybody looks at. And where are we? Well, we're just sitting here trying to maybe break out, right? So we've been tracking this every time we're together, and maybe trying to break out to the upside, but I don't think it's going to go much farther than 4,600 if it gets that far. And to me, if I look at the action, it looks like we want to go south for the winter. The NASDAQ, although higher, has struggled, and it looks to have found some new resistance right about there, 15, right about where we are now, 1566, 1570. We don't look at this with a scalpel. We trade with a butcher knife, right? We can't be exact because the numbers are never going to be exact. But yesterday's volume was pretty good, and then today's volume is kind of lousy. You had CPI yesterday, which is I would say another BS number. Again, CPI is the inflation index, and they tell us it's 3.7, and I say no chance that 3.7 is the number, because if I look at my monthly bills, they're more than 3.7% more than they were last month. So, you got to take everything the government reports, because the numbers are kind of curb fitted to make things look better than they are. But I always encourage everybody to look in their own spending habits. What are you buying? Are you still spending as much? Is your credit card bills going higher? Do you have money for an emergency? And then today we had PPI, which was also hotter, which really what it tells us is that, guess what? The Fed is going to continue to raise rates, okay? And, of course, what does that mean? It means your mortgage rates are going higher. It means your lending's going higher. It means we're going to pay higher the taxes in one way or another, because, we the taxpayers are the debt holders for the bonds that are out there, okay? Remember, the government creates nothing but debt. So when you look at the picture, it looks kind of quirky here, and I would say that, in my opinion, the next couple of months could get pretty ugly here. I think you could see a potential repeat of 08. Now, I'm not predicting. Don't go out and sell everything and worry that we're going to collapse. You have to let the market tell you. But when I'm looking at the bigger picture, I could see a lot of reasons and a lot of issues out there that certainly would lead me to believe that there's going to be some problems here. And one would be the emergency lending rate. Okay. That's where the banks go to the Federal Reserve in emergencies. And that's never been this high, which tells us what? That the banks are probably over leveraged again. So no matter what they tell us in their annual or their monthly stress test reports about how the banking system is running, I'm going to tell you that I believe, and I believe for quite a while, that they're well over leveraged. And again, who gets to pay for that? Oh, we do, the taxpayer. Gasoline, oil, crude oil is going to the moon. Here, let me go back to here. I got to switch my screen. Bang. Okay. Well, crude oil, as we told you the other day, crude's going higher. There you go. It's breaking out again. Now, why is it going higher? Well, because we decided that we didn't want to produce our own oil. Okay. We decided that, well, we didn't decide, but somebody decided for us that we wanted to be held hostage by the criminals at OPEC and in Saudi Arabia. Okay. Now, I'll tell you why that's happening, in my opinion, okay, is when you look at the picture, okay, remember that every gallon of gas that we buy, you are taxed by the federal government taxes. There's an excise tax on gas, which is tax money for the federal government. So if the higher the prices go, the more taxes that they collect. So why do they care? What do they care that we have a 300-year supply of gasoline in the United States, that would not affect the environment or the carbon footprint, which they continue to tell us that the climate is changing. And again, whether you're a believer or not, I personally am not. But hey, I'm not opposed to clean environment. But as long as China and Russia, China and India are going to continue to burn coal, which they are, they represent over 40% of the world. So you cannot change the carbon footprint, okay, until you get China and India to quit burning coal. So again, there's so many things that go on, and of course, we the taxpayer are always the ones who have to foot the bill. It's just like the $1 billion that just went to Ukraine again. Well, who do you think pays for that? Well, it comes out of the tax fund. Okay, and the biggest joke of the week was the prisoner that they exchanged $6 billion for, and they insist that the taxpayer didn't pay for it. Well, how else did it get paid? Did they return Coke bottles? Okay, to get that money? They don't. Since government only creates debt, the money had to come from somewhere, and so somewhere is taxes. That is their only revenue source, is taxes. Okay, so I guess we did pay for it, and I think again. So when I look at the picture and I look at what's going on, and I go, well, the crude is rallying, and I would firmly expect, or certainly expect, crude to be in the hundreds probably by the end of the year. Okay, I look at the bonds and the notes. Okay, and of course these are the futures on the bonds and the notes. These are the notes. This is the key benchmark. For those of you who remember, they used to use LIBOR, London Interbank Lending Rate, as a guide to do loans, and then they switched to the 10-year because they found there was a little shady activity with LIBOR. Okay, but either way, so now the 10 years are now like 4.4%, which mortgages are around 7 and change. And I think that the 10 years is going to go to 6%. So this chart goes inverse to interest rates. Okay, this goes down, interest rates are going higher. You look at the bonds, the 30-year bonds, they're also lower. Now it's interesting. If you've ever heard the term yield curve inversion, okay, what that means is that right now, if you want to borrow money for, let's say, 90 days, your rate's going to be higher than if you wanted to borrow that same money for 10 years. Okay, so the curve is inverted, and instead of going the curve should go like this. The lowest rate should be here, and as you go up the curve, okay, they get higher. Instead, the curve goes like this now. So the highest rates are at the short end, and the cheapest rates are at the long end. Okay. So that's a problem. And historically, that has always been a problem. That has been a recessionary tale. Okay. A tale telling you there's problems, because why is short-term money so much more expensive than long-term money? Because they need the money now. There's a big demand for money now. Okay, which means that people are in trouble that need to get these things taken care of. So when you look again, and I don't want anybody to take away that you got to run out and sell, but I'm giving you the warning signs today that are going to be a part of tomorrow. Now, tomorrow could be actually tomorrow, or tomorrow could be a month from tomorrow. But in the near future, every major market meltdown did not just magically appear one day. Okay, it wasn't, today we're going to sell the market. 1987, October 19th, I was actually there. I traded on the floor during those days. Okay, it didn't magically go down on that date. It went down. It went down from August of that year, and there was more warning signs accumulating. And then the week before was a little bit snarky and a little bit ugly, and then they just finally, boom, everybody sold. Okay, in 2008, October of 2008 just didn't appear. Okay, there was warning signs going all the way back to late 2007, and you knew, or you should have known, that when Paulson comes out on Face the Nation and says that our banking system is strong, that the banking system is not strong, and there's a problem. You know, if you're a sports fan, every time a coach gets the reassurance vote from the owner, typically they get fired within a couple of weeks. Well, that's when the government or when people in power start telling you that everything's okay, that means you better start to worry. And again, I'm not telling you to panic. I'm not telling you to jump off a building here. I'm telling you just be careful here and understand the warning signs that are out there. You know, they show up every single day. Inflation, you know, we don't get an accurate reading of inflation, but the average American family is paying $700 a month more this year than last. Okay. You've got gas prices that are 30% higher this year than last. But they continue to tell us about our CPI index. You've got the farming community in trouble because, of course, grains continue to stay low while the price at retail, the divergence between wholesale and retail has never been this wide. Okay. So the farmers are getting punished. So, you know, if you believe like I believe, I think that China's got their hand on the scale. I think China's trying to keep the grains down because they want to buy more farmland. They'd like to dominate the farming world as well. Why? Because they want to control the food supply, because whoever controls the food controls the world. So there's so many different things out there. And again, does it mean they're going to take effect tomorrow? No, it doesn't mean anything. Your biggest key from a trading standpoint, okay, is to watch the tape or watch the market, the printing, the trading, okay? Because at the end of the day, it is all about the trade and what goes on and the footprint that the market leaves. And the market will leave you a footprint that will leave you a clue of what it's going to do. And all you're watching is right here, okay? And it'll tell you. So this is the bonds, and they've been in a downtrend. And of course, interest rates have been rising regularly, okay? So what do we know? Well, okay, so we know that, okay? And you know, again, by itself, is it a big deal? No. You know, if you remember and learn to remember that there are two types of inflation that you have. You have good inflation, which is when there's high demand, okay, and you have to the buyers are overwhelming the supply, forcing prices higher, which is great. That is good news because that means people are making more money. It means they can spend more money. And it means that prices can rise and we continue to all be happy. And then there's the government created inflation, which really we make less money. We have to spend more money. The cost of living, your income cannot keep up with the cost of living. And it becomes a taxation without representation, which at one point or another, we went to war for that. So that is what you're watching. And that is what we are seeing. Okay. You know, this is the whole model, okay, of the economy, okay, and how fundamentals tie in. Now, we don't typically trade fundamentals, but what we do see and what will eventually play out in the charts is, you know, as you look at the S&P, I mean, really, the big picture is it's really just sideways, okay, but it is, you know, slightly moving higher here and longer term. And again, this will play out at some point. And at some point, you know, I think, and I'm pretty confident that I'll be proved right. In fact, as we look at the markets right now, they're all up. The Dow, the Nasdaq, the S&P, and the Russell are all higher. I would bet you, not bet you, but I would say to you, it would not shock me, and I would not fall off my chair today if by the end of the day, these markets, half of them were lower, if not all of them. Okay. The action just does not look very good. We have very low volume, and low volume in a week that should be very heavy in volume because this is the triple witching cycle week. Okay. And triple witching, okay, is usually creates a lot of volume. It doesn't have to necessarily create a lot of price movement, but it creates a lot of volume. And we're not seeing a dramatic amount of volume. Now, I assure you tomorrow we'll be very busy, but that order flow or that paper that's going to trade tomorrow does not necessarily hit the trading floors or the world. There's a lot of crossing, they call it, but they do have to show the volume. So you'll see, and if you go back and just look, like if you go back to June, see the big spike in volume in June. That was a June expiration. That was the biggest volume day of the month. Okay, You'll see. Oh, thank you. You'll see the same thing coming probably tomorrow. It'll be the biggest day since the last quarter expiration, and so on. Here, that's March. I can tell you where they are before I see them. Okay, because again, those are things that happen, but it doesn't mean that it's good or bad for the market. It just means that there's some volume showing up. We need the price action to start to show up, because the news itself is really not good enough to sustain or propel this market higher. However, it is higher, and there is an old saying in the world that money will go to where it's created best. Okay, so in this case, right now, and until further notice, the people that invest still believe that the best place for money is still the stock market. And again, history tells us that the stock market is the greatest place to invest, because, of course, over history, the stock market has gone up 8.5% year over year for almost 200 years, and no other asset class has ever had that kind of growth over that kind of period of time. So, again, we can't tell the market that today is the end, but when the market ends, you'll start to see it. But it won't just end in one day, especially now with all the restrictions and circuit breakers and things like that. But you'll start to see, and if you're seeing warning signs now, then you think that you're getting closer. And the more warning signs that you see, the higher the probability that the meltdown is coming closer. And again, meltdowns are not necessarily a bad thing for the market. Okay, it may feel bad at the time, but if you are investing properly, if you are taking care of yourself properly, okay, then you're really not exposed to that, because you understand that if you're not over leveraged into the market, and that's the big word, leverage. Too many people take on too much leverage into a market, okay, and what does that create? Well, it creates more fear, because when it starts to go against you, the losses start to mount, which is why when you are investing, your investing should only be what you can afford and what you could. If I told you couldn't look at it for a year, what would you do? And if you can do that, then you have a chance for success, because at the end of the day, okay, markets come back down to understanding if you're buying good, solid companies that are fundamentally solid, okay, that will grow over time, then I can promise you in 10 to 15 years from now, no matter what happens, the markets will be an average of 8.5% higher than they are today. Okay. In the meantime, it doesn't mean that we won't get cut in half before then and get a big rally out of it, because it's not every year, but the long-term average. In fact, the long-term average since 1950 is 10% year over year. Okay. So if you're not over leveraging, so that you don't have to panic when the markets go into a little bit of a meltdown, then you're going to actually have capital and money to do what? To buy more when the markets are going down. Okay. To be able to buy into some weakness and average out your pricing and put yourself in a much better position. That is what you have to take and learn to understand about the world of investing in the world of trading. And it always starts with the charts. Okay. And if we go back to what we looked at, the shortest time frame, again, we've made a couple of trades here and made money. But again, if we start here, we can see that, the euro currency is kind of a mishmash. Gold is trying to rally a little bit in the short term. The notes are trying to rally in the short term. Crude oil is still going up. So everything kind of trying to either consolidate or go higher from here. But then we'll see. We'll see where it ends up playing out. But there's no reason for me to turn on CNBC or Fox or Bloomberg or any one of those jackasses who wants to preach to you either we're going to the moon or we're going to zero. Everyone there has gotten an angle, okay, which is to try to make your money, okay. Just look at a chart, okay. You can see, no matter what chart you look at, you can formulate an opinion. You look at Apple, what would be your formulating of your opinion? You would have to assume that the bounce we have here is probably sellable. Okay, now, would I sell Apple long term? Would I liquidate my Apple position if I had it? No, I do have it. And no, I'm not liquidating. Okay, I'm actually hedging it. But it doesn't mean that in any given day for a short period of time, I wouldn't short it for a day. Okay, and take an additional position. And again, you can look at anything you want. Look at Amazon. Amazon continues to go higher. Okay. So would I want to sell this? Of course not. Again, so what you're looking is you're going to each individual chart or stock, okay, that is giving you a footprint of the market, which should then help you make the best decision. Now, again, the investing and trading are different. Okay, investing is a much shorter time frame, depending on what your time frame is. Okay, my time frame is from 4 minutes to a couple of days, depending on what, if I'm doing something in the option world and selling a spread, it's a couple of days. Okay. If I'm trading actively futures, it's 3 or 4 minutes. Okay. So I'm looking at different things to make different decisions. But if I'm investing, I'm not really, excuse me. If I'm investing, I'm not really looking at anything. I don't really care. Okay. We go back down to, look, I'm playing the market statistics on a historical basis, year over year, 8.5%. That's it. Goodbye, good luck. And that's all I'm thinking about. So I don't look at my own long-term portfolios. I can't tell you the last time I opened a statement because I'm not selling them. Okay. The only time I would ever sell one of my investment stocks is if something fundamentally changed with that company. Okay. That's all I care about. I'm not worried about what happens over the next 3 days or the next 3 weeks. It doesn't matter. The only thing I care about is if, like, the perfect example is General Electric, GE. GE had a solid fundamental change in who they were a number of years ago. That was a good reason to dump GE. Okay, if you were concerned about it. Okay, Apple, nothing's fundamentally changing Apple. It's going up and down. Okay, so again, we're not fundamental traders, and certainly when you're trading, you're never using fundamentals. Okay, when you're trading, you're simply using the charts, the price action that we see. Okay, no matter what the time frame of the chart. Okay, that's all we care about. That's the only thing that matters. Okay, is where am I in comparison to the chart? Where is the support and where is the resistance? And how can I make the most amount of money by making the trade here? Okay, and if you do that, then what you're doing is you're creating yourself to a much greater opportunity over time. Okay, and again, I can't stress it enough. So we go back and look at the short term. Is there anything going on? Not really. It kind of peaked and we're kind of, hit. We found a little bit of resistance. Now, is this real resistance? Is it short term? I don't know. We'll see. Okay, but certainly you can see that there's definitely some resistance coming here. And if you look at, for example, oil is telling me by the price action that it's not done trading today. There's going to be a big move somewhere in here. Okay. And again, so, all we do is either, look closer in to try to pin it down. Okay. So if I come in tighter, okay, well, look at that. It's still within that range. Okay. So there's no reason for me to do anything about it right now because the market's not telling me what to do. So I might as well sit back and wait. Okay. In the meantime, gold is getting hammered right now. And gold will be something that, if it continues to go lower, I might be looking to be a buyer if it gives me a reason to buy. And right here, it's not really giving me a reason to buy. There's some support. So gold should probably bounce from here. And again, I'm not interested in trading that small of a range. But again, you should expect the potential bounce. And there, look at crude. Now it's coming down to the bottom end. So is it going to break down from this bottom end here? Or is it going to bounce right back up to the top end? Okay. And that is something you're watching at all times. Okay. These are things that help you make your best decision as you work over and look at markets. Okay. You're looking for what you're really trying to do as a trader is to create the highest amount of probability on the next trade you make. Okay. we know already that every trade is not going to be a winner. As much as you'd like them all to be winners, we know that the next trade is not necessarily a winner. I can give you the most perfect setup in the world. That does not mean it's going to win. Okay. Your job as a trader, not an investor, but your job as a trader is to defend against risk. And risk comes in many different ways and many different times. But you have to determine a dollar amount of risk, which would be based on your portfolio size, and you have to make sure that you do not make exceptions, okay, to the risk model that you set up, which starts out with a trading plan, okay. And in fact, on Tuesday we'll do trading plans. We'll start to build a trading plan for everybody, because today I got to cut a little bit short in about another couple of minutes. But it starts with planning. Okay, planning is very important to what you do, because you have to know what you're going to do before you do it. All right. It's easy to enter stocks. It's easy to enter futures. It's easy to get into a trade, but how easy is it to get out? And that's your job, because the biggest problem with most is the exit strategy. Okay. And understanding that, you know what? Hey, I got to take a loss here. I have to know what my loss is going to be, and I got to be willing to take it when it comes so that I can move on to the next trade. If you do not do that, what do? You end up putting yourself in a position and start to lose your mind, which is another big story in markets is the mental side of the trading world. Okay. And when you get to the mental side of the trading world, it causes a lot of people a great deal of grief over time, because mentally they don't get it. Okay. And then, of course, you start thinking, what did you do wrong, or what did you do right, and why didn't it work? Versus making it as automatic as you can. And that is the key to successful trading, is making it as automatic as you can, so that every decision that you make, okay, and here I'll give you two great examples. We bought the crude oil here this morning. Okay. We did make this trade. It didn't go right in our favor right away, but we did make the trade. We ended up making a little bit of money. Okay. We sold the euro currency up in here. We made money. Okay. And again, not every trade is going to be a winner, but my point is that we knew the minute I put the trade on where I'm getting out. Okay. I got a number. I have a mathematical number that I give everybody when I'm trading live. This is how much risk we can take. Okay. We cannot afford to take more. And the key is to be able to clear your mind so that you can move on to the next trade. Okay. And the next step. If you don't do it that way, all you're really doing is putting yourself in jeopardy for no reason. Okay. Think about it. So why should you put yourself in jeopardy? Okay. So in the meantime, sorry guys, I'm going to cut it short today because believe it or not, I made a mistake, which is hard to believe, but I'm sorry. I'll see you on Tuesday, but we will do trading plans on Tuesday. Ruben and Max, thanks guys. I appreciate it. Sorry I screwed up, but we'll be back in full force on Tuesday. Have a great week, everybody. We'll see you later.